To our first guest ever here on Bloomberg West, Marc Andreessen, the great Marc Andreessen. He's transformed himself from the inventor of the Netscape browser into one of the most prolific investors in Silicon Valley. His venture capital firm, Andreessen Horowitz, has stakes in 4 of the hottest companies: Facebook, Twitter, Groupon, and Zynga. Marc, wow, and welcome to Bloomberg West.
Thanks for having me.
So what is it about Twitter that has investors and now investment banks so excited?
Well, I don't want to talk about specific companies, specific investments, as crazy as that will drive you. But in general, there are a group of new major global franchise internet companies. And there's a set of them here in the United States. There are some others in China. There's some others emerging around the world. And they're becoming very serious, very important, very big franchises. They're staying private for much longer than companies used to. But the businesses are very good. And a lot of these companies have tremendous growth, we think, ahead of them.
So why do you want to put money in these companies at a later stage rather than putting money in other companies at an earlier stage?
Yeah, well, we do both. We're actually a cross-stage fund, so we do seed investing, venture investing, and growth investing across all 3 stages. But when we make growth investments, we do it because we think that there's tremendous market expansion ahead. And the big thing we're looking at these days is there's now more than 2 billion people on the internet. In 5, 7, 8 years, there's going to be 4 billion smartphones in the world. And so the end market for these companies has just gotten extremely large and much larger than it used to be.
Marc, one of the things that's interesting about your fund is that you guys invest at all levels, not just an angel level, not just a sort of post-angel level, even up to the mezzanine level for these companies. Why do you guys do that with your fund? It's an unusual approach.
Yeah, well, our goal is to be invested in the best companies. So the best companies going after the biggest markets, the best entrepreneurs, the best products. And our experience with that is sometimes you can catch them early, but if you can't catch them early, it's still a good idea to try to become involved with them at a later stage. And so we basically have essentially liberated ourselves from a strategic standpoint to invest in all 3 stages. Where we focus, though, is we only invest in computer science. We only invest in companies doing internet or computers or software. And so we really restrict ourselves. We don't do clean tech or biotech or cars or rocket ships or lots of other stuff people are doing these days.
Are you at all concerned about Wall Street's interest here? I mean, is this making the deals more expensive for you to get into in the private rounds?
So there's no question there's a big influx of money into the growth stages of the companies that have hit sort of a level of critical mass where I think their success is becoming indisputable. But the attention is focused on a fairly small set of companies. There's really 5, 6, 7, 8 companies that it's focused on. The rest of the landscape is still pretty normal. And so when we're in other growth deals or we're in venture deals, the sort of money that you're seeing coming into some of these big names is not coming into kind of one category earlier. So we still think there are a lot of opportunities.
So, all right, so you've got the consumer-facing internet companies maybe getting all the excitement. Everybody else is left to their own business. Does it change the way your fund works? The exit happens at different times. The IPOs might happen earlier or later because of all this public interest?
Well, so in general, what's happening, right, is the IPOs are happening much later. So the IPO market for technology, got all but shut down. Following the reforms after the sort of collapse of the equity bubble in the late 90s. So as a result of Sarbanes-Oxley and Reg FD and so forth, it's become much less appealing for many new technology companies to be public, and many of the best new technology companies are deferring IPO for as long as possible. And so what that's really translated into, I think, is much greater opportunity for firms like ours that can invest privately.
We know the SEC is looking into the trading of private shares on these private exchanges. Do you think these deals will survive regulatory scrutiny?
Oh, I think it's a matter of the specifics. I think the securities laws are actually quite clear. I think in general, the companies, at least that I have experience with, you pay a tremendous amount of attention to the details of the securities law. It's possible that there's some activity around the edges with third parties that may or may not, stand up under scrutiny, but that's for the SEC to figure out.
So do you think the SEC could or should change public markets regulations to make them more attractive for some of these large, very successful private companies?
Well, so in general, I would say the answer is yes. Maybe not for these companies, but in general for the health of the economy and the health ecosystem. And what I'd really point to is if you adjust for GDP growth, the number of public companies in the United States has dropped in half in the last 10 years. And so essentially the market's become a 2-tier system where you have a much smaller number of large public companies that sort of normal people can invest in. And then you've got essentially all the growth companies are on the private side where there's a much smaller group of people who can invest. And so it's one of those things, if you have special access, it's fantastic. But it's not as healthy an overall system for the economy as if companies are able to go public and access the public markets. And so the disparity has just gotten too extreme. And it would be good to bring things kind of more back to normal.
We're back with Marc Andreessen, who had this great idea in college for a thing called a browser. You're stuck with that. I've known you for a long time. One of the things really interesting to me is that you've taken the browser experience that you went through, the Netscape experience, the antitrust experience, and turned it into something else. What did you learn from that? When you look back on that, do you look at is there one big takeaway that you have from those golden days?
For me, it was a hyper-accelerated, almost business school. I mean, I didn't take any business classes in college, but it was an incredible education on how to build a company. So I've just basically tried to take everything we learned in the process of building Netscape and then apply that both to other companies that I've started and then also, working with all the entrepreneurs we work with.
But second acts are rare. I mean, are there things that you learned about management? Because investing is hard. Yeah. Inventing is hard. Yeah. You've done both with some great success already, and I wonder what the common theme is.
Well, it's a little early to know on the investment front.
We'll see. So far, the valuations look good.
But I appreciate the credit. I think it's a matter of, I guess the big thing I'd say, every success in this industry is a special case. It's very, very hard to generalize. It's very hard to make sort of sweeping observations. It's always specific people. It's a specific person or a small team of people against a specific idea at a point in time, and then against a big market. And when you can line those things up, magic happens. When you can't line those things up, then there's a lot of waste of time and energy. So I guess I really sort of bring a very focused view on how to try to line all these things up.
Mark, everyone thought Explorer had kind of won the browser wars, but they're certainly heating back up again with Mozilla, Chrome taking more market share. You've got RockMelt. Why are you putting your stake in RockMelt, a more social browser?
Yeah, well, we think there's a really big opportunity to basically reinvent the browser. So first is the browser market has really opened up. So in the last, basically, I think it's in the last 4 years, 500 million people have switched browsers. And you've seen the rise of a whole set of browsers like Chrome and Safari and Firefox and Opera that each have over 100 million users. And in general, there's just tremendous dynamism and tremendous change happening in the browser market. But the thing that hasn't changed is what the browser actually does, what it actually, the interface, what it actually looks like, how it actually works with the user. And so we're basically, at RockMelt, we're basically reinventing the browser around the services on the web that we now know that hundreds of millions of people like to use. And so services like Facebook and Google and Twitter and others to come. And we think we can provide a much better, much more modern experience by doing that.
What do you make of the cloud? It's this thing that's gotten investors so excited. One of my bosses said, if you cough cloud, your valuation doubles. Yeah. But when you look at the cloud, what is it and what does it mean in terms of your investments?
Yeah, so it's actually, if you look under the covers, it's a pretty big architecture shift in kind of how computing works. And it's basically the idea that computing moves out onto the internet in a much more pervasive way than used to be the case. And so, for example, virtually all new consumer internet companies we see that come in and pitch us to try to raise money, they're virtually all building on top of cloud services like Amazon Web Services or like Rackspace. So they're almost all doing that. And it's the same thing when companies are doing payments, they're using a cloud-based payment service. Or when they're running their Salesforce, they use a cloud application like Salesforce.com. Where people are using Gmail and Google Docs instead of Microsoft Office or Exchange or Outlook. And so that is it's a very, very big architecture change. Our experience in the industry is that when you have a big architecture change, you tend to have a new generation of companies that become very successful on the back of that architecture change. And we think that's what's happening right now.
What trends out there are you most excited about, and do you think there's anything that's being overhyped?
There are always individual things, specific things that are being overhyped, although I don't want to pick on specific companies. In general, I would say what's happened in the last 5 years is sort of perception has caught back up with reality, which is the reality is the internet has advanced tremendously, and the technology industry has advanced tremendously over the last 10 years. Technology was so deeply out of favor in the middle part of the last decade that basically what we're seeing now is a snapback where people are realizing, hey, the products that are out now from a lot of companies, Apple and many others, are incredibly compelling products. There's more than 2 billion people on the internet. Broadband is fully deployed. The smartphone has arrived. And so I think perception has caught up to reality. It's kind of where we are right now.
One of the biggest reasons we've launched this show is the idea that we're in a new set of paradigms in technology that aren't really widely understood. Mobile computing, the cloud, social media. How do you keep up to speed with those companies so much so that you can decide what few companies to invest in the future?
Yeah, so it's basically, it's one of the reasons we decided to go pro. My partner and I have been angel investing for 5 years, and then we started the venture firm in part because it's so incredibly time consuming. There's so much going on. There's so many new companies. There's so many great entrepreneurs running around with all kinds of new ideas. And so for us, it's just like, it's an 18-hour-a-day day job. And so, reading everything in sight, talking to everybody we could possibly find, using as many of these things as possible. If I ever have a spare moment, I'm on my Android phone, I'm in Google Reader, and I'm reading like all the tech blogs because I'm literally every day trying to keep up with what's happening.
You've got a majority stake in Skype. What kind of challenges does Skype need to overcome in order to be ready to go public?
Oh, I'm sorry. I can't. Unfortunately, that's a topic that I can't talk about, other than to say we love Skype.
You use Skype?
Oh yes, all the time.
For what?
Oh, everything. It's a fantastic. I mean, it's the audio quality. It's a fantastic voice experience. It's now a fantastic video experience. So we use it all the time for business. We use it all the time. Everybody in the office uses it constantly for personal.
And it seems like there's a lot of changes within the IP video space.
Yeah.
A lot of new companies. A lot of companies trying to find ways to do it professionally. You see Cisco, coming with great guns with all their new ventures. It seems like every year there's a new sort of IP video thing happening there.
Yeah. Well, so it's representative, actually, of the cloud discussion we just had. So now that you have high-speed data networks deployed everywhere, right, which we all talked about 10 years ago, we didn't have, the networks weren't deployed yet. Now that we have the networks deployed, voice and video, which used to be completely independent networks, telephone network or whatever, now voice and video are just software. They can just be done as software on a data network, which means they can get better all the time, which means you can have completely programmable voice and video experiences, build lots of voice and video-based applications. So it's a brave new world for all that stuff.
Back with Marc Andreessen of Andreessen Horowitz, that has taken the future of the internet, the best places to invest now, and thank you for wearing a tie. I really appreciate that in Silicon Valley tradition.
Anything for you.
Well, we got to impress New Yorkers with a necktie, so we got to have a whole different look. When there's talk of the bubble and talk of this valuation, these private, how do we know when we're in a bubble?
Well, I think the main way we know we're in a bubble is when nobody thinks we're in a bubble. So, my experience with bubbles is when everybody's completely convinced and completely bought in, that's when it's time to worry. And one of the things that's characteristic about the environment right now is a lot of people think we're in a bubble, which to me means we must not be.
Now, I would say it's when there's follow-ons, or there's companies that aren't involved in the cloud or in tablets sort of masking themselves as that. It's not when you've got obvious leaders like a Twitter or a Zynga or a Facebook, but it's when there's sort of pretenders to the throne using that as valuations to get out the door.
Yeah. So Warren Buffett talks and says there's innovators, imitators, and idiots. And the stage of any financial sort of period is you go through those three phases. And I think one of the things about the current environment is the companies that have the most heat on them from an investment standpoint as a group are extremely high quality companies, clearly innovators. I don't even think we've seen the imitators yet, much less the idiots. But, we're human. Give us 5 years, 10 years.
We'll get idiots.
We'll get there. Yeah.
Marc, you've seen the rise and fall of some of the greatest technology companies. I mean, right now Facebook seems to be on top of the world. Is anybody safe?
So I think in general, I think every company has the ability to be as inventive and as innovative and as competitive as it can possibly be. I think that this is an industry that rewards ingenuity, it rewards aggressiveness, it rewards innovation. It punishes stagnation, it punishes bad management, it punishes failure to innovate. And so I think it's in every company's control fundamentally over how long it's able to sustain success. And I think the most successful companies in our industry are successful because they're so good at innovation.
Something you've surely learned with following companies and being at the head of a company is there's a time at which the inventor might not be the best person to run the company, but sometimes it is.
Right.
Bill Gates has done pretty well, albeit with the help of some antitrust complaints that you might have better than most. But how do you decide when the inventor is not the person to be the CEO of the company, especially when you've got such an important role as an investor? Yeah,
so our preferred model is for what we call the founder CEO. So the founder who is capable of then becoming the CEO and ideally running the company for decades in the ideal case. And the reason we believe that so strongly is because if you look at history, from IBM to Hewlett-Packard to Digital Equipment to Microsoft to Intel to Oracle, and then more recently companies like Amazon and Facebook and Google, you see these companies being run by their founders for a very long period of time. There are fewer cases of great franchises being built by professional CEOs. The paradox, of course, is that not every founder is capable of doing that. And so a big part of our process as an investor is to work through and try to find the founders who can do that. And then if we have to replace the founder with a professional CEO, to get a professional CEO who's willing to act like a founder. And that's really hard.
But it seems like quite often that's the investors who are pressing for it. We're going to do the IPO, so we need an old guy in a suit to run the company. Do you feel like you can bring a different sort of a look to that? Is that one of your advantages?
Yeah, I think so. So we've always had a starkly different point of view on that. We've never had the approach you described. We've always had the other approach, which is let's look for the founder CEO. I think one of the really healthy things in the Valley right now is because of the recent success of companies like Google and Facebook and Amazon, there are more investors today, including more investors on Wall Street, who understand the founder CEO model than I think has ever been the case. Because you watch Jeff Bezos and you're like, of course, like if we have a founder like Jeff Bezos, we want him to run the company. And again, not every company has that, but when you have that, you don't want to force these people out. And I think investors are figuring that out.
So what kind of situations would you say where the founders are not capable of running the companies that they created?
Yeah, well, the main thing is the founder willing to devote himself to the craft of management and really learn how to manage a company consisting, and any successful technology company is going to end up with thousands or tens of thousands of employees. And so when as you get to know and get exposed to people like Andy Grove and Steve Jobs and Bill Gates and so forth, and Jeff Bezos, what you realize is they're very, very serious about management. They take it very seriously. They're very good at running their companies, but they've chosen to make themselves good at running their companies. The problem generally is with the founder who just simply either won't take it seriously or for some reason can't take it seriously and can't apply himself or herself to it. And that frankly is often a tragic case. Those companies often don't survive.
Now, you're on the board of Hewlett-Packard. You're investing in a lot of different companies. You've got some more active roles. How do you figure out when you're spending enough time on a certain thing? And I mentioned on HP, I know you don't want to talk about that, but I mentioned that because there's been concern in that company and many others over the years when people on the board aren't paying careful enough attention. How do you know if you're paying enough attention to the things that you're doing and divide your time up to be most effective?
Well, there's a general answer and a specific answer. Right. So the general answer is I'm just constantly working on time management. So I have an allocation model for how I spend my time. I review it all the time. I try to make sure I'm responsive, especially the projects that I'm most closely involved in, the people relying on me, that I'm incredibly responsive. I try to keep up with everything else. Inevitably, stuff drops off the plate. One of the advantages of building a venture firm, I now have 26 colleagues who work with me, so that's a big improvement from when I was doing this, when my partner and I were doing angel investing on our own 2 years ago. But still, it's day-to-day effort. From a board standpoint, boards are interesting. You actually don't, in either big or small companies, you don't want board members actually spending too much time in the company, because the purpose of management in a company is to run the company. And when boards get too involved, it means management is weak. And so you want boards, we believe, you want boards to focus on having the right management in place and providing governance and providing supervision of management, not actually running the company. And one of the failure cases with boards is when they get too hands-on.